Hi, I'm Bill Blain. I'm strategist here at Shard Capital. Today I'm going to talk about green bonds and the UK government's first ever Green Gilt. Now, it fills my heart with joy to know that Britain has just issued the first ever Green Gilt and received 137 billion of orders from investors for the 10 billion issue. It's a record historical amount for any UK sterling bond or any nation's debut green bond issue. Now, what are gilts? They're UK government bonds. They're called gilts because the original paper certificates had a gilt edge around them, hence gilt edge securities. Now, the UK has been issuing gilts since 1692, when King Billy borrowed 1.2 million via the new Bank of England to finance war, yet another war, with France, which was pretty much what gilts did for the next 170 years, all the way into the 1860s when they paid for new fortifications against Napoleon III. Now, the UK government pays for some of the goods and services it provides the population through taxation, and for most of it through borrowing in the gilts market, which is now the second largest and second most liquid government bond market after US Treasuries. The bonds, the gilts, are issued by the UK Treasury via the Debt Management Office, the DMO, and they're bought by investors and held long-term as assets. In that respect, they're no different to any other bonds. There are all sorts of gilts across a whole range of different maturities. There were once even undated permanent gilts, perpetuals, called war loans. But these bonds, which were issued to finance wars from the 19th century right the way through to the First World War, have now finally been paid off because interest rates are so low today. Gilts can come in short, intermediate and long maturities. Normally they pay a fixed interest rate, so the new Green Gilt pays 0.875% every year. Or they can pay interest linked to inflation, what we call linkers. Now, typically, most of the big UK real money accounts, that's pension funds and fund managers, hold gilts as their most important and largest asset class on the basis that their principal and their interest is absolutely safe. Each year they get paid the coupon, and they are guaranteed by the UK to be repaid their money when the bond finally matures. And that historically has always been the case. There has never been a gilt default. As a result, gilts are considered to be the risk-free asset in the sterling markets. UK gilts will not default because if, let's say, the country was to find that the Treasury's piggy bank was empty, the government can actually just go out and print more money to pay back gilt holders, which is pretty much what's happening today with quantitative easing, where the Bank of England comes in and buys gilt issuance, enabling the government to issue more gilts and keep interest rates low. Now that has all kinds of consequences, and we're not going to talk about these today because I've talked about them often enough before. The key thing, though, about the nature of the bond market is that if you are going to be building up any kind of retirement portfolio, you're going to have part of it invested in bonds. And typically that used to be 60% in gilts and the rest in other financial assets such as stocks and commodities. Now, that has clearly changed because of the changing interest rate scenarios, but we can talk about that later. Let's instead focus on the Green Gilt that the UK government's just issued. Investors tumbled over themselves to place orders, hence the 137 billion book, but they all knew it was going to be a 10 million issue. None of them would have been surprised when they got a fraction of the number of bonds that they put orders in for. Everyone expected that the orders would get scaled back. When investors believe that a new deal is going to be hot, as this new Green Gilt clearly would be, they inflate their orders in the expectation allocations would be cut. So I wouldn't be too impressed by the huge size of the order book. It actually doesn't mean anything. The key thing is where the bond actually priced, where it cleared the market. And that new deal yields 0.872%. That means that every year investors will get back 87 pence for every £100 they invested. Now that is actually a marginally lower yield than where a normal gilt would have priced. It's reckoned that the greenium, that's the premium that the Green Gilt achieved in terms of a lower yield, was about 2.5 pence in every £100. By calling this bond green, a Green Gilt, this translates to a saving of around £28 million in the total interest paid through the 12-year life of the bond. Effectively, that means that doing a green bond has got the UK 47 minutes of government funding for free. Yep, in 47 minutes, the UK runs up about 30 million of debt. Anyway, what makes this bond, this Green Gilt, green? Well, the government has said that the proceeds of new Green Gilt will specifically be earmarked to support green projects, including zero-emission transport, like green buses and building up charging stations and offshore wind projects. And the interesting thing is these are exactly the same things that government could have financed through its normal borrowing programme of normal gilts. Now, when I was young, which admittedly was a while ago, the UK Treasury would have refused to have ever done such a Green Gilt. The golden rule then was that government funding could not be hypothecated. That means allocated against any specific project or asset, because civil servants perceived that that would risk budgets becoming a political auction house, much like in the United States, where pork barreling means that senators and congressmen can insist that their states are allocated specific projects and project spending monies in return for their vote to pass a budget. So previously, UK governments have never allocated cash like this, but they'll be pleased by it. Alex Sharma is going to chair COP26 in November, and he's going to be able to smile and point out how the UK is saving the planet by issuing green bonds, and that our green bond is bigger and juicier than Italy's green bond, which was only, I think, 8 million euros rather than 10 billion pounds. But why do investors want to lap up green gilts in the way that they just have? Why are they better than normal gilts? Well, that's all about fashion. It's no secret that the Green Gilt is a product of its time. Every single global fund manager is desperately keen to demonstrate to their investors just how much they care about the environment and climate change. So, some banker, probably, hit on the idea and persuaded issuers that investors were just desperate to buy anything labelled green. At the same time, the same banker was probably persuading these same institutional fund managers that their investors, that's people like you and I saving for our pensions, were equally keen and desperate to invest in anything green. Thus was spawned the market. Everyone suddenly wants to go green and invest in ESG compliant bonds and green bonds and socially aware bonds. But the reality is that retail investors and small savers are now faced with a growing plethora of notionally better bonds, green bonds, but their yields are even lower. Recently, a large fund active in commodities turned down one of the alternative asset deals that I'm working on the basis that it's too oily for us these days. They said they'd rather go and buy wind farms because what their investors want is for them to be invested in green projects. I pointed out that since everyone else wants to be invested in green energy and wind farms, the result has been that the price of wind farms has gone through the roof and the yields have fallen. It is impossible now to get a decent risk return on investing in wind farms or other alternative energy sources. Anything oil related though, forget it, you cannot fund it, even though they offer very good returns and most are fully climate mitigated, in other words, capture all their carbon or pay for carbon credits. The reality is that any good bond manager will tell you that green investments depend not on what the label or a politician says they're going to be spent on, but what is actually done with the money and how that process is governed and managed. And this is where I'm really suspicious of Green Gilts. The way in which the UK has rushed into green spending and climate change mitigation has been a political exercise. From an economic perspective, it's joined up as much as a full stop on a blank page. In other words, not at all. Let's take the current energy crisis, where the government has cut gas storage reserves in the UK to 1%. That means that in 3 cold winter days and the UK could run out of power. Not a problem, says the government, we can buy it from Europe. No, they can't, because Europe is short of gas and Russia's going to keep it that way for their own political reasons. And then the government minister will tell me, oh, but don't worry about that, we've got lots of wind farms and solar power generating 25% of the country's needs. Yeah, that's fine during the summer or when the wind's blowing, but when there is no wind, which happens during the winter when the UK is sitting at the centre of a blocking high, what happens is that the winds come from the north, from the polar regions and Arctic Siberia. And that's when wind farms don't work, when it's at its coldest. Oh, and it's not even worth saying that solar is not going to work in the middle of the winter. Of course, the UK does have utterly reliable and predictable alternative clean energy. The oceans around us give us some of the strongest tides on the planet, and these are completely reliable. Anywhere, every single day on the UK, there are tides circulating around our little island, and we could go and harvest that energy. But the problem is that at the moment, tidal technology is unfinished, it's unproven. It's going to take a long time before it is. But people who want green bonds today aren't willing to wait. They want to buy product that they can put into their green portfolios immediately. And that means that long-term projects like wind and in the future hydrogen, which we could power our whole economy with, are going to take much longer to finance because they do not provide immediate solutions. And I think this is where government's wrong. In the rush to look green, to sound green and be seen doing green investments, governments are spending on immediate projects like less than efficient than promised wind and solar farms, but also socially dirty projects like lithium batteries. We're building all the wrong things. Climate change will not be solved overnight by issuing a green bond. Climate change will be solved by long-term, well-thought-out projects, and many of them will look intuitively bad. Gas is a very good example. It may take 30 years to completely decarbonise our economy, and in that period we're going to need gas to provide us with power. But if you'll seek financing for a new gas field or gas treatment centre, you're not going to get it. Anyway, none of that's really going to work or be worth worrying about at the moment, because today the Chancellor of the Exchequer will be celebrating his record UK Green Gilt, and the investment banks will all be collecting the rather significant fees they got from lead managing the deal. The fact a Green Gilt doesn't do anything that a normal gilt couldn't do except pay investors slightly less yield, really is a good illustration of just how it's all about marketing rather than planet saving. We need to go back to first principles, and I don't think green gilts are part of that. Anyway, thanks very much for listening to this light bite. We'll be back to rant about something else next week. Thanks very much.